I have always wondered myself, why do we have to hear this every time, what the stock market is doing? When the market is booming, we are made to believe that the economy is booming. And in India, the stock market has mostly been booming for almost 20 years now. But if you add up all the goods and services bought and sold in the country, the actual economy, that number isn't growing as quickly as it used to. Wages have hardly budged in decades, and the average Indian family's net worth still hasn't recovered from the Great Recession. So, what exactly is the stock market measuring? To understand what stock markets are measuring, it helps to imagine a very simple business like a lemonade stand. Jack is the owner of the business. He tried to get a loan, but the bank said it was too risky. The rich investors weren't buying, but Jack has another option. He can go public, giving anyone who wants to the chance to invest in his business through something called an IPO, initial public offering. Investors pay a certain amount, say $1, to own a small part or share of Jack's business. Jack sells a bunch of shares and grows his lemonade empire. Jack can put that money towards opening new lemonade stands, which means more profits. Jack can put some of those profits toward developing new products. Jack can also give some of that money back to his investors. Those are called dividends. Jack doesn't have to do this, but it does help to get people excited about his company and more likely to buy his stock. Like Jim, he was sick on the IPO day, but he thinks Jack is the smartest guy in the whole world and thinks that this lemonade stand is going to be huge. So he offers to buy some shares from the original investors for twice what was paid for them. That's the stock market. It's people buying and selling tiny pieces of companies based on how much they think the price will be worth in future. Except in real life, it's happening thousands of times a second all over the world. There are stock markets everywhere, but the New York Stock Exchange is the big kahuna. It's been around since 1792. Today, it's where the big companies like IBM and GE are traded. The Nasdaq is the cooler younger brother. It was born in 1971 and doesn't have a physical location. All the trading happens electronically. That's where you find tech companies like Apple and Facebook. So in America, if you want to know how the stock market is doing, you want to know how both these exchanges are doing. That's where the indexes come in. They take the whole bunch of share prices and transform them into one clear number. The S&P 500, like India's Nifty or Sensex, tracks 500 of the largest companies on both the exchanges. While the Dow Jones is a lot more exclusive, it only follows the 30 companies it considers the most important. In 2015, it booted out AT&T and replaced it with Apple. The Dow and S&P are the big American indexes, but other countries have their own indexes to measure their stock market. Today, many of the world's biggest companies are publicly traded, but that wasn't always the case. Companies discovered what Jack discovered, that if you allow the public to buy shares, you can grow a lot faster. Shareholders want to make money. So if the CEO makes a really bad decision, they will start selling their shares, which will drive the price down. The opposite is also true. The possibility of a future payout encourages people to invest in new risky ideas. That's the whole idea of stock market as a force for good. It drives companies to make good decisions, so they have more money to give back to shareholders and more money to grow and create jobs, and that's good for everybody. For people who knew how to play it right, trading their stocks could build a fortune, like this guy, Warren Buffett, America's most famous investor. Buffett is famous for a particular style of investment, value investing, careful analysis of the company, looking at their balance sheets, looking at their businesses. But if you don't have time, here's the tip from man himself. Buy an S&P 500 low-cost index fund. An index fund puts a little bit of your money in all the companies in the index. Basically, you're hitching your wagon to the stock market. The other option is to give money to the professional investors who, for a fee, try to beat the stock market. Picking stocks is a hard game, but there's one popular strategy. This guy, John Maynard Keynes, a Nobel Prize winner and one of the most influential economists of the 20th century, he noticed that it's not the real value of the companies that drive their stock prices. It's the most popular story people believe about those companies. Sometimes those stories are backed up by facts, sometimes not. Another economist, Milton Friedman, so famous he was invited onto popular talk shows to help explain his philosophy. He thought companies should have only one obligation, and that is to make profit for shareholders. And corporations take his advice. They start tying up the top executives' pay to share price performance. Well, if 80% of the CEO's pay is based on what the share price is going to do next year, he or she is going to do their best to make sure that the share prices goes up, even if the consequences might be harmful to employees, to customers, to society, to the environment, or even to the corporation itself in the long term. CEOs put more money toward things that would increase the stock prices in the short term, like cutting costs or buying back a bunch of their own shares to decrease the supply and artificially bump the price. Between 2007 to 2016, that's how the companies in S&P 500 spent more than half of their earnings. Another 39% went to their shareholders as dividends, which did not leave much to raise wages or to expand or to develop new products, things that are good for the economy in the long term. So the choices that you make in terms of investments and people and in capital are different than if you want to make an investment and generate a return within 24 months. Laying off workers, closing factories, keeping wages low. These are the things that are bad for an economy overall, but can be great for companies' short-term profits. And that's what the stock market cares about. As the stock market has grown, so have the CEO paychecks. In 1973, the average CEO made about 22 times more than the average worker. By 2016, it was 271 times more. And as the stock market has grown bigger, fewer people have benefited. The share of the people invested in the stock market is at its lowest point in 20 years, as the middle class has dropped out. So it's not surprise that the stock prices have gone up. So has the inequality, but it doesn't have to be this way. Stockholders can influence how companies behave, whose interest they take into account. Most of us are thinking about our long-term futures and want our companies to make money by doing things that are good for the world and not by harming people and destroying it. That's what most shareholders really want.